Hi, this tax strategy that I'm about to share today is one that is heavily used by the super wealthy to create generational wealth. But it's actually a very simple tax strategy that you and I should definitely also take advantage of. It will save us a lot of money in taxes by paying zero capital gains tax. But before we dive into it, let's make sure everyone's on the same page about what the capital gains tax is. So if you purchase an asset, a rental property, a stock, a business interest, and it appreciates in value over the years, when you sell it, that gain, what you sell minus what you originally paid for it, that gain is called capital gains. And Uncle Sam is going to want a piece of the action, right? So the part that the government takes is called capital gains tax. Capital gains is taxed at different rates. If you sold the asset within its first year, that is considered short-term capital gains. Short-term capital gains tax rate is tied to your income tax rate. So if your income tax rate is 25% or 29% or 35%, then any gain you made on that asset will be taxed at that same rate if you sold it within a year. But if you hold that asset for a year and 1 day, then it's considered long-term capital gains. And the long-term capital gains tax rate is much kinder. Depending on your income bracket, it could be 15% or 20%. If you are in your peak earning years and you're of a higher income tax bracket, then your capital gains tax rate could be 20%, but that's the max. Say you retire, still holding on to your assets, and then you sell it, but you're at a lower income bracket, then the capital gains tax rate would be 15%. Do you notice a trend? The longer you hold on to this asset, the lower the tax rate. The government values our holding on to our assets long term so much that if we're willing to hold on to them our whole life and then transfer it to our heirs, they're willing to forego the capital gains tax. So you see, this is a very legitimate tax incentive. The government wants to encourage us to hold on to our assets and will reward us for this particular behavior. This is also called a step up in basis. When it goes to your heirs, your children, your nieces, your nephews, the cost basis of that asset steps up to the market value of the asset at the time of your death. Here's a quick example. Let's say out of sheer pure luck, I bought NVIDIA stock for $1,000 10 years ago. And when I die, the stock is worth $1 million. If I sell that stock 1 day before I die, I would have to pay capital gains tax of 15% of $1 million. Close enough. That would be $150,000 in capital gains tax. But if I don't sell the stock and I die 1 day later, the stock goes to my heirs. The cost basis of that stock, instead of being $1,000 when I originally paid for it, the cost basis steps up to the market value of that stock at the time of my death, which would be $1 million. So if my children sell the stock the next day, they would be paying zero capital gains tax. Now that we understand how step up in basis works, how can you and I take advantage of it? I can share with you what I've done. One, I'm going to hold on to my assets, brokerage accounts, rental properties, business interests, as much as I can and pass it on to my children so that I end up paying zero capital gains tax. Secondly, I decided to invest in rental properties because when I sell a rental property and purchase a bigger rental property, there is a special 1031 exclusion that allows me to defer the capital gains tax. Normally, capital gains tax kicks in when you sell something. Let's say you sell your Apple stock today. Even if you're going to use the money to buy another stock, you still need to pay capital gains tax on that sale. But rental property has a special allowance called the 1031 exchange, where if you sell rental property A and you purchase another rental property, as long as it has a higher value, you don't need to pay any capital gains tax that you made on the profit of selling that first property. In this way, you can keep deferring your capital gains tax to bigger and bigger properties, which means bigger and bigger capital gains, which means bigger and bigger capital gains tax savings when all that assets is transferred to the next generation. Third, I will not be gifting my house to the kids. Sorry, kids. But if I give this house to you today, then the cost basis does not step up. The cost basis remains what I paid for it originally. So if you decide to sell it, that will be a hefty, hefty capital gains tax rate you have to pay because it's been a big appreciation since I bought this house almost 30 years ago. The fourth decision I made was quite an unusual move. Because I'm not selling the house and because I'm not gifting the house to the kids, what do I do with a house that's way too big for me, right? So I decided to turn it into a rental. I will make a separate video on my decision of turning my primary home into a rental. It was a pretty up and down journey. All right, let's answer some frequently asked questions. 1, can I apply this tax strategy to any assets? The answer is no. Common assets that you step up in basis are your primary home, rental properties, non-retirement, brokerage accounts, stocks and bonds, and any business interests or business ownerships. You cannot apply step up in basis to IRAs, 401ks, any retirement accounts such as the 403b that public school teachers get, for instance. Next question. If I transfer my assets to my kids before I die, can they get a step up in basis? I know I've answered this question already, but I still want to emphasize it here. The answer is no. Step up in basis only activates when the transfer is at the time of death. If you give your house to your kids before you die, then they get the original cost basis, the original amount that you paid for. What if the stock is not good? Should I still hold on to it until I die so that my kids can pay zero capital gains? The answer is definitely not. Don't ever let tax savings, not just tax savings, but just in general, do not let tax savings considerations cloud your investment judgment. That's like having the tail wag the dog. You may end up losing more money in the value of the investments than any potential tax savings. The next question is similar. What if my house is no longer a good fit for me? Should I hang on to my house until I die? And I have the same answer. Do not let tax saving considerations cloud your judgment or curb your lifestyle. Especially if this is your primary home, because there's some tax exemptions that are allowed with selling your primary homes. Even if you've lived in the house for a long time, you may be looking at a huge appreciation and thinking, wow, that's a huge tax. But don't forget, if it's your primary home, you get the home sale exclusion, which is $250,000 for a single person, or if you're married, $500,000. Secondly, you may have made some capital improvements in the house, fixing the roof, adding a new deck, a bay window, or a new HVAC system throughout the house. Those capital improvement expenses can be deducted from the capital gains. So if you're a married couple and your house has appreciated $600,000, after you take off the $500,000 in the home sale exclusion for the couple, and you've taken out some capital home improvement expenses, you may end up with a very tiny capital gains, in which case the tax wouldn't be much. So why would you hang on to a house that's not a good fit for you instead of just paying that small capital gains tax? In my situation, I held on to my house and turned it into a rental property because I was trying to do more rental investments. If you found this video helpful, subscribe to learn more and more about estate planning. If you're new here, my name is Martha Chang. In this channel, I decode estate planning concepts so you can avoid probate and minimize your taxes. And always remember, I am not your attorney. I am not your accountant. I'm just a random girl on YouTube. Please consult your advisors before you make any big moves. And if you're looking for a big overview of estate planning, consider getting my book, Estate Planning Decoded, rated 5 stars on Amazon.